The deal number 5 of private equity is represented by replacement financing. If you remember, replacement financing means the financing of a mature company. However, this definition doesn't help us a lot. We have to understand better what stays behind this label. The word replacement can help us because in replacement financing, the role of the private equity is to replace another existing shareholder. We have to understand better this mechanism for two different reasons. The first one, replacement financing, is a very broad definition, and behind this definition we have evidence of 3 different deals we have to investigate. The other aspect is related to the fact that in replacement financing we modify a bit the DNA of private equity, where the DNA of private equity is based on a concept that a company needs money and the private equity is going to finance the company. In the case of replacement financing, we modify this kind of definition. But step by step, let's start. And first of all, we have to highlight the names of the 3 different deals we find in replacement financing. The names are the following: buyout or leverage buyout, PIPE, and corporate governance deals. Let's start with buyout. Buyouts are very popular within a private equity, especially in US and UK. If I consider these 2 markets, buyouts more or less represent 40–45% of the market of a private equity. What are buyouts? Buyouts are deals of private equity based on a very specific technicality, where the technicality is the technicality of the buyout. With a buyout, the role of the private equity is not yet to finance a company, but the role of the private equity is to identify a potential target to buy 100%. When the private equity identifies the potential target to be bought, the private equity creates an SPV, where SPV, as I mentioned in the clip before, means special purpose vehicle. The SPV is an empty shell where the private equity investor puts equity and becomes the 100% shareholder. The private equity collects a lot of money through debt, and on average the proportion between debt and equity is 80%, 20%, or 90%, 10%. That means the SPV uses a lot debt. Using debt and equity, the SPV receives an incredible amount of cash. With this amount of cash, the SPV is able to buy another company. And the acquisition could be an acquisition driven by a negotiation, or could be also a very aggressive and hostile acquisition that could happen also through a public offer launched in the stock exchange. At the end of the process, the SPV became the owner of the target. That means the private equity becomes the 100% owner of the target. The only consequence of this process is that the company bought by the private equity receives inside the balance sheet all the debt of the SPV. After the acquisition, the purpose of the private equity is not to manage the company, but to keep in the portfolio for a very short time and to sell it to another buyer. But this time, the selling process, it's honestly very easy because the private equity has the possibility to sell the 100% of the company. These deals could be good, could be bad, in some cases could be honestly very aggressive, especially if the private equity is going to use a lot of leverage to buy the target. The second deal is represented by PIPE. The term PIPE stands for Private Investment in Public Equity. Also in this case, as it happened in the buyout, the DNA of the deal of private equity is honestly modified. Is modified because the starting of the story is not a company needing money, The starting of the story is again the private equity willing to run an investment. In this case, the investment of the private equity is a minority investment run in a company listed in the stock exchange. That's pretty strange, because in the clip 1 I said private equity is not public equity, and in this time the private equity is going to invest in a listed company. This is not strange, because the idea of the private equity is to make profit, not trading the shares in the stock exchange, but buying the share and selling to another buyer using a price which is not related to the stock exchange. How does it work? It works in a way in which the private equity is able to buy a minority share, and the bet, the gamble, the assumption is that this amount of share could be enough to decide who will be the owner of the company. And as you can imagine, if you have shares enough to decide who will be the owner of a certain company, you do not have a problem to negotiate the pricing. These kind of deals are becoming very, very popular in the US, but especially in Europe, where the target are represented by banks, and private equity investors are going to invest in banks listed in the stock exchange. The last deal is represented by corporate governance deals. Also in this case, the DNA of the private equity is modified, because the beginning of the story is not related to need of money of the company. The beginning of the story is represented by a fact that the company needs to reorganize the corporate governance. For example, in a succession story within a family business. In this case, the role of the private equity is to buy some share from an existing shareholder, to become an insider of the company, and to work as an insider to redesign completely the corporate governance of the company. If the private equity will do a great job, the private equity will be able to sell the shares to the new shareholders of the company. In countries in which family business is very important, like in Italy, in Spain, in Germany, these deals are nowadays very common.